the federal government gives or actually charges if you buy a property and then sell it, you made a profit, so you have to pay taxes. People don't know this. You have to pay 15% to the federal government, and then it's about 9.3% to California, depending on your income. Most incomes in California, the tax is 9.3%. If you make over $330,000 a year, then the tax is higher. But the federal government gives you a tax exclusion. That's one of the federal government's way of encouraging home ownership. The federal government wants people to own homes. People own their homes. They have more vested interest in their community, stronger community. That's the theory behind it. So you could have $250,000 of profit and pay no taxes if you're an individual. If you're a married couple, you could have $500,000 of profit and pay no taxes. However, people in California, 62% of us, as the map shows, homeowners, have more equity than the capital gains tax limit and therefore have this tax burden when you sell. So, for example, here's a scenario. Let's say someone bought a home in 1985 for $100,000. I'm just giving you an example. It sells in 2025 for $1 million. Let's just say they have write-offs, things that improvements that they made and costs that they've incurred of $200,000. So I'm not sure if you can see my cursor, but my cursor is showing they sell the property this year for $1 million. They have minus 200 in write-offs, minus 100 the purchase price they bought it for. They have a taxable gain of 700,000. That's a capital gain they're supposed to be paying taxes on. If they're an investor, they're going to have to pay 15% of 700,000 or 105,000, and 9.3% of 65,000, which is 65,000. So they're going to have to pay taxes of 170,000, right? That's a lot of money that maybe if you didn't know that you have to pay taxes on if you don't buy another property that's more expensive, 10-to-1 exchange. If it's the home where you live in, you made 700,000 the taxable, but you're married, so you minus 500,000, so your gain is 200,000 that you have to pay taxes on. So you're gonna have to pay 15%, and 9.3% comes out to 48,000. That's a lot of money. 48,000 is a lot of money that maybe someone didn't expect they're gonna have to pay in taxes because their property value went so high. So just basic information from the article, that exclusion of $250,000, $500,000 for a married couple was put into place in 1997. Since then, property values have increased by 260%. So if that's the case, if they were going to adjust the taxable what you're not taxed on, then it should be $660,000 for individuals and 1.32 for couples, married couples today. And according to this article, this hidden tax discourages homeowners, especially older adults, from downsizing or relocating because they want to pay the same large tax. Larger homes that are going to sell for more or appreciate more stay off the market. They don't downsize into smaller homes. And so that makes sense. There's less people trying to sell into a smaller home. That less people selling makes prices go up for everybody.